consumption index, all of them lower in trade today. So we'll discuss that. But Power Finance, that is the stock in focus on the back of its fourth quarter numbers. The revenue is up 20% and the net profit also rises 18% on a yearly basis. In fact, my colleague Abhishek Kothari spoke to Parminder Chopra, the chairman and managing director of the company, and began by asking her about the implications of RBI's draft paper on provisions for power projects. Let's listen into that conversation.
See, I think that RBI has always been focusing on prudence while talking of the project financing. So if I talk about the concerns on the PFC's accounts, so you would be knowing that we are following India's accounting standard and not the ICAP. We have already switched over to that. So in NDAs, the RBI has clear-cut directed that any difference between the ECL and the IRAC has to go to as impairment reserve. So first of all, I would like to say that on the front of affecting the profitability, we don't foresee any impact on the profits of the company, as this is going to be as an impairment reserve. The second part, yes, I agree that that is going to adversely impact on the capital adequacy as well as on the loan growth. But you know that PFC, while declaring the results, we have also shared the capital adequacy above 25%. And that to Tier 1 capital around 20%, 23%, as against the RBI norms for 10% as the minimum tier capital. We don't foresee that this is going to have a major impact on PFC, either on the front of maintaining the capital adequacy or on the loan growth. There is another reason that when we analyzed our portfolio, that 25% of our total portfolio is the projects under implementation. Out of this 25%, around 45% is the projects under generation, where we have a longer tenor and there could be impact of the extension in DCCO, which RBI is talking of having the additional provisioning of 5%. So on overall basis, this is not going to have much impact, and the details are yet to be, these are being examined, and I think the details will be worked out when more clarity on these guidelines or the final guidelines come out.
Well, yes, this is a draft consultation
Yes.
that they have put out. Will this cause slowdown in the, fresh capex that is being built up in the power sector?
There could be some effect, but as far as I know, that from the PFC's point of view, we are having sufficient cushion on the capital adequacy front, and our focus is on the distribution sector and the renewable sector. Renewable, which has a comparatively smaller gestation period, as you know, and the distribution sector, where most of the loans as of now are backed by the government guarantees. So we are not foreseeing much impact on those lines.
How are the DISCOMs dues shaping up as of now?
After implementation of the LPS, you know that there has been a tremendous improvement in the liquidity across the system. If we talk that before introduction of the LPS, there was outstanding dues of 1,39,000 crore of the various GENCOs towards the DISCOM. That has diluted to the extent of 73%. So only a minuscule portion is left. Apart from that, the current dues, if we talk, after the introduction of the LPS, around 9 lakh crore billing has been done by the GENCOs to the DISCOMs. And I'm happy to share that we have not seen any major defaults in that. So the liquidity across the value chain in the power sector is improving a lot. On the dues of the DISCOM sector towards, if you ask about the lenders like PFC, so we are not facing any issue in realizing our dues from the DISCOMs till now.
Will this draft regulation, if implemented, that will increase the cost for power industry as a whole, and if the norms comes into effect?
There will definitely be some impact. But how far it is going to be impacted, it all depends on the market dynamics. We are talking of 5% provisioning, and in case that goes beyond 2 years, maybe another 2.5% provisioning, over the life of the loan. When we disburse, definitely it's going to have immediate impact, but that provisioning, since these are the long-term financing which we are providing, so we are not seeing much, maybe except for the few initial years.
Well, last time you guided us for a 12 to 15% growth for FY24 with respect to the AUM growth, and bang on, it's been at 14%. How do you see the trend in AUM growth going ahead? Which segment will drive, like thermal, green energy, etc.?
Growth, I'm happy that we have been able to achieve the targeted growth, which we were saying that it's going to be somewhere between 12 to 15, as you rightly said. And we expecting that we will continue on the similar levels of growth going forward, at least for the next financial year. About the segment, if you are asking me, then the segment, primarily it could be the distribution, where the focus is on lending towards RBPF scheme. Apart from that, we are going to have focus on the renewable. But we can't leave the thermal also, because till the time that a stable renewable system is found in place with the proper storage either through battery or through pump storage, the coal is going to act as a backup and provide us the energy security. So from that, some disbursements are also going to go towards thermal also.
Well, renewable has been your focus area over the last few quarters, and this time around you have seen that AUM growth of 25% in that particular book. Now, what I observed in your AUM growth over the last few quarters, you are reducing your dependency on state or government, book. That book share as a percentage of AUM has reduced from 84% to right now about 81% odd. So, is there a conscious effort to, increase the share of private in your overall AUM, or would you like to maintain a share of, let's say, 80-20?
See, for that you need to understand the dynamics of power sector. In the power sector, DISCOM is primarily with the state government, and if we talk of the renewable, where we are finding the growth to happen, that is predominantly most of that is the private sector. So we are growing our private sector business through funding for the renewable primarily. For the DISCOMs, all disbursements are being done in the state sector. So we are not finding that there is going to be a much shift in our portfolio, 84 to 81%. I don't think that's a really a big change for changing in the portfolio.
Just noticed a trend of change.
Yes, definitely. Going forward, when we lend more and more to the renewable sector, that is going to add to the private sector book.
How do you see your net interest margin and spreads in the coming quarters? Now, they have largely been flattish over the last 1 year. So, do you see them improving in the coming quarters? And what is your comment on cost of funds going ahead?
We have always guided the investors that our spreads are going to remain within the range bound somewhere between 2.5 to 2.75, and similarly margins somewhere around 3 to 3.5. The only difference what could make is that at the time what is the cost of funds, one, and how leveraged is our book. So where you will find that the changing of the numbers. So market dynamics, that we have reduced our cost of borrowing from the previous year, which has led to improvement in the spread as well as in the margin. So what we are finding that we are going to continue with a similar trend, and we are going to be range bound on these two fronts.
So AUM growth continuing at 15% range?
I'll again say from 12% to 15%, somewhere that way.
Well, some very important commentary coming in from PFC there, especially some clarification regarding the impact of the RBI draft circular. But let's now slip into a short break. When we return, we'll be joined by Ruchit Jain of 5paisa.com to give us a technical check on the market. Stay tuned.